All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Market's been open here for just a little more than an hour, and been an interesting open. We saw, the gap down, and it gap below Friday's lows, and we've talked about how that just doesn't really matter all that much. Some of those kind of normal tendencies, not when the market goes like this. It would be abnormal for those things to matter all that much. But we get an open that's just a free fall slide. And market drops about 25 points, from its opening value there. And it doesn't do it on huge volume. But you look at the volume today, you compare it to Friday, it's much higher today than it was on Friday. And today's a Monday, so it's, it's one of those where, significantly more volume across the board as some of that selling came in. We've also seen things get bought up on significantly more volume here today. And, this is, we're almost right back to where the market opened here in terms of S&P futures. So that's what we've seen here. It was interesting because at the lows, Apple was green. Apple didn't go red near its lows. You could kind of see it open up a little bit higher. It spiked up, bled a little, but has held up pretty well. You take a look at some of the banks. Bank of America opened up, and this is one where the market was bleeding lower, and Bank of America just wasn't. We started to see some of this out there in the market, this morning, which is not the case for a lot of things. What we have been seeing. And so some very, very bullish, action in some of these things while the market was falling. Now, what was driving the market lower? Well, healthcare. It was an open and sell in healthcare. J&J, nowhere to the same degree as Friday. This is much more in terms of the United Healthcare, your Humanas, your CVS's, but they've all kind of gone different directions. It's not like you can look at these and go, oh, well, they just opened up and sold off, and there's a lot of differentiation, that has occurred here with them this morning, and I think that's the, and me, I try to analyze as little as possible and observe more. But when you go and analyze this market this morning, right? We're not seeing big, massive metric changes. We're not seeing big, massive bottoming volumes or anything where you go, wow, okay, this means that. But we are seeing something that is typically characteristic of bulls stepping in even when the market's red, and that is differentiation. That is seeing different stocks doing different things, and we're seeing it in different sectors. We're seeing it across sectors, and that is typically a little bit more bullish. Now, that's not bullish in terms of providing a 50-point market bounce. Okay, that's bullish in terms of, hey, you know what? Things aren't going to fall off of a cliff right now. Right, that's all that is, and that's all we're seeing here this morning. Could we rally 50 points on the S&P? Well, yeah, we sure could, right? We sure could, but it would require a little bit of a catalyst. It would require a little bit of, some sort of news element to come in there for that. But we see that differentiation, and then the other thing that we saw that's just different that we just have not seen on sell-offs is we see the VIX up, and it's up 6% right now, and the VXX is up 0.4% right now. What we have been seeing has been the opposite, where the VXX has outperformed the VIX. And what is that telling us? Well, that's telling us that futures, in the future are pricier, and we're seeing future volatility is actually dropping compared to current volatilities out there right now in the market. So both, semi-bullish type of things. We're dealing with market internals that are incredibly oversold, and that's what they are. And that is not that's not changing here. Now, this morning, I stepped in. I bought some Bank of America, personally, but not with options. The options are terrible. And I went to look at Micron for the challenge as I got a short-term buy signal. Went and looked at the options and thought, oh geez, no way. But you can see the move above the 7-hour moving average here. Stochastics moving above 20, and we're in that oversold MFI position. So really nice signal here when it comes to Micron in terms of the short-term bull signal. But the options just pretty ridiculous. And so I decided not to add that exposure, especially since I already have Facebook in terms of tech. So do I need double tech exposure? Nah, not in this market. But anyway, over the weekend, not a lot of news, not a lot of info that you look at and go, wow, this is this matters or this matters. It was a weekend rife with speculation. It was a lot of speculation, and I think names that I haven't heard from in years. Some that were famous because of the financial crisis, who were running funds that did really well and subsequently went bankrupt or closed their funds after because the same strategies didn't work. Coming out and making major calls on oil and on gold and on the market, and a lot of that. A lot of that kind of stuff out there, but no real information, no real news. Market is looking towards the FOMC meeting here this Wednesday, where the Fed is expected to raise rates. And, you see a lot of speculation about that. I think MarketWatch had a headline this morning that said, is the Fed about to wreck this market or derail this market or something of those terms? Let's see if it's still up. Let's see here. And again, they're trying to get readers, right? But let's see. No, I don't see it up here anymore. Yeah, I don't see it. It was this one right here that's now been changed to more than half the S&P 500 stocks are now in bear market territory, which basically means that more than half of the S&P has gone down more than 20% from its highs, right? That's that's basically what it says here. With it. So anyway, that's some of the market, what's going on. Not a huge amount of what I would call, major change. We did see the Empire State Manufacturing Survey this morning, and came in sharply lower than expected. And this kind of confirms some of the other stuff that we have been seeing when it comes to manufacturing. We have been seeing the manufacturing, the PMIs, the ISM data, continue to slow. They're still showing growth. It's still a 10. It's still showing growth, but that growth is slowing, right? And we get a curve that starts to look like this. We haven't rounded and started to come down, but we're at this point where, the growth is seriously slowing here with these manufacturing surveys, and a lot of that is is worry and concern, and rightfully so. Now, in the market, there are a couple things, and there are a couple things to keep in mind. There are a lot of tools out there, right? Meaning, we can go and use various screeners. We can use different charts, right? We can pull up charts. We can look at fundamentals. We can look at different money flows. There are a lot of different tools and ways to look and to analyze stocks. The analysis in the market is infinite. There's always something that can be analyzed. There's always something that can be looked at. And analysis is constantly changing. Throughout 2016 and 2015, what did we hear of? Oh, the Hindenburg omen. Every time we get a Hindenburg omen, the market crashes, right? And, referring to, the Hindenburg back in, many, many years ago, right? And it stops working. All of a sudden now we keep getting Hindenburg omen, and instead of the market crashing, it just keeps going up higher. So what worked? Not really working again. And most analysis tools, That's very common. You'll see we can overlay charts and put on a MACD and go, wow, this MACD models the price action phenomenally well and is a nice predictor. And then we can overlay it to different price action and go, wow, you just do the opposite of the MACD. That's the nature of the market. That's the nature of analysis. And we can go out and we can do all the analysis we want. For example, we can come into the banks and we can go and analyze them. We can look at their fundamentals. We can look at their price to book value. We can look at their PE ratios. We can look at their revenues. We can look at their, their trading. We can look at a lot of different elements and analyze it. But we have to remember that analysis does not equal change. In 2016, everything was worth basically what its fundamentals said it should be worth. I mean, that's the way 2016 was. Not a lot of change. Things traded where the analysis was. But in most markets, that's not the case. In most markets, there is a big difference between the analysis and the fundamental analysis and where the stock is actually trading. For instance, Bank of America, we can go out and we can analyze Bank of America fundamentally, right? And we can make a good argument that this stock should be worth $34. We can go make a fantastic argument that it should be worth $34. But it's not. It's not worth $34. It's worth $25 right now. This is normal. This is what markets are about. Why is it so different from its analysis? It comes down to one word. Fear. And the more fear that comes into the market, the more differential we see between analysis and where prices are trading at. And you say, well, don't the fund managers go out and take advantage of it? Well, no, they're fearful too. Because what if their analysis is wrong? What if something changes? What if, a nuke flies? And, what if things with China get worse? And what if we go into a recession? And what if this and that? There's a million what ifs. And when that fear factor rises, stocks trade different from their analysis. So I can go out and, for instance, Alibaba, which I believe is a $300, possibly $400 stock, I go analyze it all I want. Is that going to change the price? Am I going to sit here and go, well, man, I wonder why it's not trading at my analysis price? No, I know exactly why it's not trading at my analysis price. It's fear. It's absolute fear. And that is a component that comes into stocks and is very heavy in stocks now. And it's one of the reasons why charts are so important, because you can start to see where that fear starts to change. And when you switch in from a fear mode into much more of an analysis mode, and where stocks are going to go to what they're really worth. And when we look at Bank of America, we look and we go, well, no, it's still in that heavy fear stage, fear that the fundamentals erode, fear that the fundamentals get worse, right? It's one where, we saw in the financial crisis, we saw Bear Stearns go from, a $100 stock to nothing, right? We saw Washington Mutual, boom, gone, Countrywide, gone. Right? And that was when fund managers had fundamental analysis with real values on those stocks. So things can change, and that fear element is what kind of creates these offsets. So I can go out and I can analyze, and I can go and say, well, Bank of America should be worth 34, but I'm pretty insane if I go and say, well, I'm going to go buy a weekly option, and I'm just going to price it out at 34, and it's going to go to 34 this week because my analysis says it is. No, what's my analysis do? My analysis makes me bullish. My analysis says, hey, you know what? Just wait for an opportunity to buy when the technicals start to look good. And when they do, yeah, I'll buy it. I'll be involved in it, right? Because I think there's a big differential between what the stock is worth and what the stock is trading at. Now, this happens on the other side, right? Fear makes stocks cheaper than what they're fundamentally worth. But on the other side, exuberance makes stocks worth more than what they are fundamentally worth. For instance, Pepsi. We go out and analyze Pepsi, and we put historic metrics on this. This is a sub $100 stock. Trading at $115, that's ridiculous. When it comes to Pepsi. That's crazy talk. But it's traded up there. Why? Well, we could argue fear, right? Fear of being in other stuff. But there's kind of been an exuberance here with it. Okay, we know that. All right, so my analysis says, boom, it's probably coming down here. Now I'm looking for an opportunity. Saying, okay, when do I get an opportunity to get in? When do I get an opportunity to play it and be involved? If I sit here and wonder, man, I wonder why it's not trading all the way down here right now. I'm missing the mark. I'm missing the right question, right? We know that stocks will trade dramatically different from what their fundamentals are. It happens a lot. Yeah, the last several years, not as much. But normal market conditions, we get a lot of these. And it's a matter of going and identifying and saying, okay, there's a big divide right here between where the stock is trading and where the stock is, where the stock should be worth fundamentally. I know that why that divide is created. It's fear or exuberance, one or the other, right? And going, all right, now I just wait for my charts. When my charts give me a bull signal, I can take advantage, or they give me a bear signal, I can take advantage and go from there. And so that's, analysis is one thing, identifying the change and when the change is happening is another thing. And so every weekend I go through my analysis, right? I go through and I analyze different stocks, and I go and I say, you know what, this stock I think should be worth this or should be worth that. Chipotle Mexican Grill to me is a $600, $700 stock. If we look at it, fundamentally. But it doesn't mean I'm rushing out to buy Chipotle Mexican Grill this morning because my analysis this weekend said it's going to be higher. No, it's one where I have to understand, hey, there's still fears out there, right? There's still fears when it comes to Chipotle, and rightfully so. And right now it's in that fear stage. It's in that sell stage. It's trading below the 7. It's trading in the lower Bollinger Band. Not a place I want to pick it up. When do we see some of that fear switch? Well, that's when I want to pick it up. And so far, we don't see that here with that. So, if you're going out and you're seeing stuff and you're saying, you know what, fundamentally, this looks really good, but yet the chart's really ugly, right? There's still fear. There's still a lot of fear out there. And you don't have to sit there and wait and go, well, you know what, let me guess the bottom here and here and here. Because for many of these stocks, the bottom could be significantly lower if fear continues to rise, right? Hey, if fears continue to get realized, right? Because fundamentals can change, right? Fundamentals can change pretty quickly. And so, it's one of those where the norm is not for the technicals and the fundamentals to match. The norm is for the price of the stock to be different than what the fundamentals are, and for there to be an eventual change, that takes place and pushes things, directionally overall. You take a look at a stock like First Solar, right? This is a company that if certain things happen, it could be worth $80. If other things happen, it could be worth $20, right? And so it doesn't get a lot of change other than just kind of the trader, jump up, jump down, because it's one where investors really just are not quite sure. But when things happen, like right back here in June, when things happen, major change, takes place, and it goes and catches up with its fundamentals. And there will be a time where the banks, either the fundamentals catch up to the banks or the banks catch up to the fundamentals. And when we look at the reports, we look at the earnings reports, and I know, that it's common to judge an earnings report based on what the stock does on earnings. I understand that's the norm, but it's not the reality. Yes, Apple gapped down and deserved to. We talked about why, but plenty of other stocks, they gapped down, even though in a different market environment they'd probably be trading higher. And so it's one where, all right, earnings happen, the fundamentals actually improved. I understand the fear factor here. Great, fear factor still on. Now I got to find a spot where I am comfortable buying. I am comfortable with with my thesis or whatnot there with it. All right. So anyway, I just wanted to kind of talk about that, the difference between analysis and change. Because even on the market vibe right now, the analysis is what? The analysis, it's a -10. It's super negative. Most of the market metrics are strongly bearish. Right? That's the analysis. We know that's the analysis. We can go to predictive and say, well, it's going to be this in the future or that in the future. Well, that's not the analysis, right? The analysis isn't a prediction. But what do we know from the analysis? That typically when we get to spots like this that are this oversold on the metrics, we tend to see a strong bounce come into the market. And for me, when I went and bought Facebook on Friday, that was my analysis. Look, market vibe is overcooked. It's overdone. Strong bounce possible. Facebook is one that had hit my radar over the last month that has been outperforming the market fantastically. And so I said, okay, you know what? I got a decent setup, decent risk reward. I'm going to buy with a little bit more time because I know what the market is right now. I know the market could continue to go through temper tantrums. And the chance of me hitting the perfect price right here, right now is almost zero. And so if I give myself a little more time, be able to kind of wait out a little bit of the volatility, then great. I have the chance of a trade really working and really doing well. I was willing to step into this risk. Right? Other risks I'm not willing to step into. Right? Other risk in the future I will be willing to step into, and so it's basically one of those where my analysis suggests that Facebook's about a $175, $180 stock fundamentally. I have some chart change that's starting to take place. Okay, I'm willing to step in, but I'm not going to wake up every morning and wonder, why is Facebook not at 175 or 180, right? The reality is it's not going to get there overnight, if it did, I would appreciate it, but I'm not going to kid myself there. So anyway, just wanted to make that point here, the difference between the analysis and the change in stocks, and fear and exuberance are what kind of keeps stocks from trading, for what their fundamental levels should be. As I watch the market out of the corner of my eye here, one of the areas where we're seeing some really, really nice snapback are the industrials. Industrials are snapping back very nicely. We saw Boeing go green early on. You take a look at a Honeywell. You take a look at a UTX. We're starting to see some fairly positive action coming into this sector. It's not differential from the market too much, but even a triple M here, which fell off a cliff after its earnings, and but with the market going back to new lows, has not come close to even testing its lows. Now down here at the lower Bollinger Band. Very, very tempting situation, but keep in mind option values are still very high. The implied volatilities are still incredibly high for most things, and that if you have consolidation, that consolidation is going to ding the value of your option. And in fact, you could be looking at a stock like Micron, and Micron could rally 30, 40, 50, 60 cents here this week, and your option go red. And that risk, I know we've highlighted that risk over and over, but it's still pretty hefty out there. It is still a very real risk overall. One area that I'm also looking at, we talked about it last week, gold. I wasn't willing to buy it last week. I wanted to see a pullback. We started to see a pullback last week, come into the space. But, you start looking at the GDX after the pullback Friday and the snapback today. Some really positive bullish action here with the GDX. You look at, some of the other miners like Rheingold, right? Not trading like the GDX. So there's still some differentiation in the space. Newmont kind of lagged on Friday, popping up a little bit here today. So, a lot of these look very different within this space. But, some of these more high risk gold miners like a Harmony, outperforming today up 4%. You're looking at an AUY up 6% today. So these low dollar stock gold stocks, really popping up, today very nicely. And I suspect that as we go forward, we're going to hear more and more about these names, more and more about these small cap gold names, and more money is going to flow into them. As when we look at them relative to where the gold price is, these are trading at levels that are pricing in gold to drop significantly more. But we're going to be probably talking about a time where gold appreciates. And we talked about why last week, and some of these could be a very nice value as we go forward. So we'll be looking at those for the challenge. I'm not going to jump into anything here just yet. I looked at things this morning and how things are, and where things are. If the market rallies into the close or sits around here, or even sells off a little from here, option values are probably going to compress and become semi-compelling. I do have some exposure with Facebook, and I'm holding this. I'm not going anywhere with it. And I know it broke the 7-hour on the open, and you can see it. Broke the 7-hour here with the gap down, but rallying off that lower band. And, it's one where we talked about it with the, even on my entry with the hourly. I don't want to be in this scenario where, here's Facebook and, buy it right here, which is basically what I did on Friday. I don't want to have to be forced out if it pulls back to the lower band and before it goes. And, unfortunately, it's pulling back to the lower band before hopefully it goes. But, it's one of those risk factors that was, fairly high with it. Okay. Alrighty. Well, thanks for hopping on. Have yourselves a great one. We'll talk to you later. Take care.